Hello, everyone. Thank you very much for being here. I want to start by acknowledging that Stanford sits on the ancestral land of the Muwekma Ohlone tribe. This land was and continues to be of great importance to the Ohlone people. And consistent with our values of community and inclusion, we have a responsibility to acknowledge, honor, and make visible the university's relationship to Native peoples. My name is Michael Mastrandrea, and I am the research director of the Climate and Energy Policy Program at Stanford's Woods Institute for the Environment. The Woods Institute is part of the Stanford Doerr School of Sustainability, and for over 20 years has brought together scholars from across Stanford to advance understanding and develop practical, just solutions to pressing environmental problems. The Climate and Energy Policy Program combines interdisciplinary research with direct policy engagement, serving as a practical, timely, and neutral voice informing decision-making on climate and energy law and regulation. Today, we will be discussing disaster insurance markets. First, Sam Hudgens, a wildfire legal fellow with the Climate and Energy Policy Program, will discuss a new report on state-chartered insurance solutions for damage from hurricane-force winds and lessons learned for policymakers in Western states confronting growing wildfire risk. Next, a panel of insurance experts will discuss key challenges faced by policymakers and insurers managing disaster risk, and again, lessons learned for policymakers seeking to reduce risk, limit financial strain, and foster a stable economy. The panel will be moderated by Michael Wara, director of the Climate and Energy Policy Program. And during the panel, there will be an opportunity for questions from the audience. So please submit your questions using the Zoom Q&A feature, and we will get to as many of them as possible. And now it's my pleasure to hand it over to Sam.
All right, my name is Sam Hudgens, and I'm a wildfire policy legal fellow at Stanford's Climate and Energy Policy Program. SEP's new white paper, Examining Disaster Insurance Markets, Lessons for the Future of Wildfire Insurance, aims to provide policymakers in wildfire-prone areas with insight as they craft responses to increasing wildfire risk. This insight takes the form of several lessons learned, three of which I'll explore in this presentation. So first, policymakers contemplating solutions to address high wildfire risk and home insurance availability and affordability issues should strive to ensure that pricing is reflective of risk. Second, policymakers should focus on pre-event financing to the maximum extent possible. Third, policymakers should develop strong mitigation programs to reduce risk, drawing from programs that have had success with making mitigation widely accessible. Before diving deeper into these lessons learned, I will begin by providing background on how disaster insurance works and what difficulties we are facing today. Natural disasters are increasing in frequency and intensity. According to a 2024 Congressional Budget Office report examining climate change, disaster risk, and homeowners insurance, since 1990, the number of natural disasters resulting in over $1 billion in damages has sharply increased. Individuals whose property is damaged or destroyed as a result of costly natural disasters rely on the disaster insurance market to shoulder the cost of repairs. Historically, the insurance industry has viewed disasters that cause infrequent but catastrophic losses, like hurricanes or earthquakes, as primary perils, while low severity and higher frequency natural disasters, like wildfires or tornadoes, are considered secondary perils. However, the impacts of wildfires has grown rapidly in recent years, and the insurance industry has increasingly devoted more resources to the wildfire peril. As more people are forced to find the means to recover from natural disasters, the insurance market in affected areas is under stress, creating mounting insurance availability and affordability challenges. So at its core, insurance is the transfer of risk. Risk related to natural disasters can be particularly difficult for insurers to accommodate for because it's an example of what's called correlated risk. Hurricanes and wildfires impact many policyholders within the same geographic area at the same time. This means that many policyholders will be filing claims at the same time, putting financial pressure on the insurer. Predictability is another factor leading to disaster insurance being more complicated. Natural disasters are not as consistent or predictable as other types of risks, creating greater uncertainty for insurers attempting to implement strategies for financing losses from natural disasters. These challenges, coupled with the heightened frequency and intensity of natural disasters that I already talked about, have been a driving factor causing insurers to limit their exposure in high-risk areas. And this leaves homeowners facing issues with insurance availability and affordability. So to address this, state governments step in and develop strategies to provide insurance in place of private insurers. This is happening at an increasing rate. A 2024 report by AM Best indicated that in some states, residual markets have grown by as much as 200% between 2018 and 2023. So when state governments create a backstop or insurer of last resort, it creates a market referred to as the residual market. And the residual market is an umbrella term under which two forms of programs exist. These two programs are FAIR plans and wind pools. So first, I'll talk about the fair access to insurance requirement plans or FAIR plans. It's useful to understand a bit of historical context surrounding the FAIR plan first. Federal legislation from the 60s requires states to provide coverage to high-risk urban properties that were denied insurance due to redlining by insurance companies. And to satisfy this, certain states created FAIR plans. The California FAIR plan was created after the Watts riots, which is pictured on the left. But today, the FAIR plans have morphed into something else. They're now a vehicle for states to provide insurance for individuals with property exposed to high risk of natural disasters. The second type of insurer under the residual market umbrella are wind pools. Wind pools are residual markets chartered by state legislatures. And unlike FAIR plans, wind pools are specifically designed to cover losses from hurricane force wind. For both wind pools and FAIR plans, each insurer admitted to provide policies in the state must contribute to a fund or an association, which in turn provides policies for those in high-risk areas. So as I kind of already mentioned, the purpose of FAIR plans has shifted over time to be more oriented towards providing disaster insurance. This photo of the aftermath of the Palisades fire and Cal Fire's hazard severity zone map are reminders of the growing wildfire risk in California and that the FAIR plan must accommodate for. Other states, including Colorado and Nevada, have also demonstrated the pattern of a shifting purpose of FAIR plans. Because the lines have been blurred between FAIR plans and the state chartered insurance programs that exclusively cover disaster insurance, it may be more effective to think about the residual market in a different way. So instead, we should consider the type of policyholders and properties residual markets are serving. We asked the question, are residual markets designed to serve policyholders who are temporarily using the residual market as they wait for private market policies to become available at an affordable price again? Or are they structured to accommodate policyholders who need to rely on the residual market in the long term because prices have become so disconnected from risk that the private insurance market will not cover their properties? We propose that the latter is true, and permanent reliance on residual markets is unavoidable once losses from natural disasters escalates to a certain level, absent mitigation efforts. So because of this, states must resort to cross subsidies to keep those living in the riskiest areas insured. In designing residual markets, states must consider difficult questions about who should pay for insurance, who should pay for individuals in high-risk areas, and how much. So to explore the different mechanisms available and how states have reckoned with this issue, the white paper examines wind pools from 5 different states: North Carolina, Texas, Florida, Louisiana, and Hawaii. By looking at the different financing strategies used by each residual market, the types of programs they employ, the changing insurance regulations over time in each state, and the aftermath of significant storm events, this paper paints a picture of how wind pools have been functioning in recent years. Laying out this history allows for the opportunity to identify lessons learned that can inform policymakers who attempt to use the same solutions in areas experiencing wildfire risk. For more context, I'll now go over some of the basics of the key financing strategies we discuss before getting back to the lessons learned. So the financing strategies utilized by a wind pool can be visualized as what's called an insurance tower, which you can see on this slide. This is the insurance tower for 2024 for the Texas Windstorm Insurance Association, or TWIA. As a first source of funds, wind pools will rely on their surplus or retained earnings, which come from pooled premiums paid by policyholders. Wind pools will also raise funds by issuing bonds on the public market, and these may either be issued before or after a hurricane hits. Wind pools also rely on reinsurance, which is essentially insurance for insurers. Insurers may purchase a reinsurance policy that is triggered at a set attachment point and provides a predetermined amount of funds to help insurers pay for losses. Catastrophe bonds, or cat bonds, are a relatively newer form of financing that wind pools rely on. Cat bonds are risk-linked securities that transfer risk from an insurer to capital market investors. Finally, when a wind pool runs out of options, To finance losses, it will issue assessments on its member insurers, which are felt as a surcharge on premiums and ultimately paid by policyholders. And it's important to take note of where each of these different financing strategies kicks in, as that can inform you to the condition of the residual market. So for example, if a state has little surplus, relies on post-event financing to cover relatively low levels of loss, and is not capitalized to accommodate for at least a 1 in 100-year loss, which is what's typically standard, it can indicate that the state's residual market is facing significant financial challenges. So now we can move back to the lessons learned identified in the white paper, so you can have a sense of the type of information we're highlighting for policymakers in states prone to wildfire risk. And so this is the first lesson learned. Policymakers regulating residual markets in wildfire-prone areas should strive to keep prices as close to actuarial pricing as possible. Keeping prices artificially low incentivizes policyholders to live in areas of high risk, and statutory language, politics, and the strategy chosen to finance the residual market can all contribute to what's called rate suppression. For example, in Florida, a statutory glide path limits the amount Florida citizens may increase rates each year. The existing caps have been increased in recent years. However, this limitation exists in tension with the fact that Florida statute calls for coverage provided by Florida citizens to be actuarially sound. Florida's insurance commissioner has limited recent proposed rate increases, and politicians in the state have taken ownership of doing so. Price suppression leads to an even greater reliance on cross subsidies, as states must source funds from somewhere to cover losses in high-risk areas. And this somewhere means from individuals who are not necessarily living in the high-risk areas themselves. Framing the dangers of relying on artificially low rates as a threat to consumers will be an important component of ensuring that risk can be taken into account adequately. Ensuring a balance between moderating rates and subsidizing risk is critical. And California's sustainable insurance strategy has attempted to strike such a balance between facilitating insurance availability to those in high risk areas and allowing insurers to incorporate increased risk in their pricing. So the second lesson learned is that policymakers in wildfire-prone states should strive to maximize pre-event financing. On the other hand, post-event financing has the potential to create long-term burdens, which may prove unsustainable, particularly in the face of growing risk. Wind pools use post-event bonding in part because it helps to keep premiums artificially low. Rather than depending on surplus from premiums or spending money on reinsurance, relying on post-event bonds allows residual markets to put off financing for natural disasters until one actually occurs. However, issuing bonds after a storm carries its own risk. The state of the bond market after a loss event may not be favorable, potentially making it more difficult to pay claims. TWIA leans heavily on post-event bonding. These are paid back using assessments on coastal property and automobile policies in the catastrophe area, as outlined by Texas statute. After Hurricane Harvey in 2017, TWIA assessed its member insurers 3 separate times after completely depleting its surplus. The only reason more assessments were not needed was because of one pre-event bond secured prior, demonstrating how investing in pre-event financing can be beneficial on a rainy day. Since then, however, TWIA has relied on post-event bonds. This could spell trouble for the residual market if a storm were to hit and its surplus fund was entirely depleted after Hurricane Beryl in 2024. The situation in Texas should be a warning sign for policymakers in a state with wildfire risk, creating a residual market that could potentially rely heavily on post-event bonding. So contrast this with North Carolina, which after significant reforms in 2009 has continued to invest in securing pre-event financing, and retained earnings have continued to grow, and that residual market has remained relatively stable. The white paper also touches on mitigation programs used by residual markets. These programs address the root of the issue by attempting to reduce the risk that creates the need for residual markets in the first place. The wind pools discussed have programs in place that provide incentives in the form of premium discounts for policyholders who make modifications to their houses. Grant programs can also provide an opportunity for policyholders to engage in mitigation. For example, in North Carolina, the Strengthen Your Roof program has been relatively successful, and funding from the program comes from the residual market's surplus. However, these programs have difficulty scaling up, with issues such as confusing application processes and burdensome upfront costs for some being cited as contributing factors. And mitigation for wildfires poses additional challenges. One individual's mitigation may not make a significant difference if it's not also implemented by other homeowners at a community scale. Policymakers in wildfire-prone areas may need to resort to more creative and aggressive solutions. For example, facilitating the implementation of Zone Zero regulations would lead to communities more resilient to wildfire. Additionally, working with homeowners associations to create standards for entire neighborhoods, something that's currently being implemented in Colorado, could be an opportunity. Overall, gaining an understanding of how wind pools have been functioning is critical for policymakers in the West dealing with heightened wildfire risk. California is currently taking steps towards reconfiguring its own approach to homeowners insurance. Senate Bill 254, which was passed earlier this year, requires the Wildfire Fund Administrator to complete a natural catastrophe resiliency study. This includes a comprehensive assessment to analyze and develop long-term reforms that protect access to insurance. So drawing from the lessons learned identified in this white paper will help policymakers to avoid some of the same mistakes that have been made by states with existing residual markets and allow for a more efficient response to instability to the insurance market as a result of wildfire risk. So thank you for everyone listening, and thank you in advance to the wonderful panelists who you'll hear from next. The white paper is now published and available on STEP's website, so feel free to take a look, and I'll hand it to you now, Michael.
Thanks, Sam, and thanks for the work on the paper. We're really excited to see the work product out and in a timely way for providing input to the SB 254 study that you mentioned in your concluding slide. So now we're going to have a conversation with, I think, a really interesting group of panelists, and I'm going to introduce them and then ask them each a question, after which we're going to open it up for some of the questions that we're already getting from the audience that are really fantastic. So our panel today is composed of Professor Don Hornstein, who is the Thomas Taft Distinguished Professor of Law and the Director of the Center on Climate, Energy, Environment, and Economics at UNC School of Law. In addition, we have Min-Chong Mao, who is the Senior Managing Director and Actuary at Aon Reinsurance Solutions. And last but definitely not least, we have Amy Bach, founder and executive director of United Policyholders. And Amy is a nationally recognized advocate for insurance policyholders who we interact with frequently. And we're really excited to have the three of you together to have a conversation about residual markets and where we need to be going and what options we need to be thinking about for the wildfire insurance challenges we're confronting in the Western United States. So I'm going to start with Don, and I should have mentioned Don is also an insurance regulator and sits on the residual market, on the board of the residual markets in North Carolina, where he lives. Don, could you just share some initial thoughts about what North Carolina did exactly to stabilize its insurance market in the aftermath of the 2008 hurricane season and the stress the state was under at that point, and what brought about the efforts and what did the state land on as policy solutions?
Sure. Well, in 2008, North Carolina had a moment that's become all too common. Farmers insurance threatened to leave the state, and it wasn't an idle threat. It actually sent out notices statewide that it was leaving, and it was leaving because the way our residual program was then designed, it felt it could be on the hook for virtually unlimited assessments in the event of a terrible storm. So the General Assembly actually appointed me to help design a law that would change the way our residual program was structured. And that's what we did and have had tremendous success since. Unlike other states, we have not seen any major insurer threatening to leave the state at all. We did two things. The first is that we made our residual program a nonprofit, which meant that in the event money was left over after a quiet year, like we're about to conclude right now, that money could be kept in surplus rather than given out to insurers as profit, which allowed us to build up a surplus. from which we could pay future losses. Basically, we could save for a windy day. And the second thing that we could do besides that is we could charge, we have no power to charge rates. We charge whatever is available. But the other thing that we were allowed to do, besides building up the surplus, is design our own mitigation program that we could administer to reduce the risks to homes up front. And pursuant to that, we've developed what probably is the largest single insurer-led wind resilience program in the world, funded now at the $120 to $150 million level.
Thanks, Don. I think that's a nice introduction to kind of both the pre-event mitigation that's so important in these catastrophic risk contexts, as well as the strategy that North Carolina adopted to stabilize the market and keep the normal private market players present and keep competition driving more choices and better outcomes for consumers. Min Chong, you have a national and even international perspective on the question of kind of residual markets, and I wonder if you could share a perspective on your experience with their role in U.S. property insurance markets and how you understand their role within the broader insurance landscape.
Sure. Thank you. At Aon, I lead the residual market practice where I assist clients to quantify the impact of residual market assessment on their overall portfolio. So clients use this information to structure their reinsurance purchasing. So in the US, a lot of the companies choose to purchase reinsurance to protect the non-recoupable assessment from the residual market. So my primary focus has been on those major residual markets that Sam discussed in his paper that include North Carolina, NCIUA, NCJUA, Florida Citizens, and so on. So my major, my understanding about the whole thing is the insurance ecosystem is involved several key stakeholders that include the insurance companies, reinsurance providers, residual market, regulators, legal environment, and the consumers. So in this ecosystem, when you see one state has availability issues, affordability issues, it may look the same. However, the driver could be very different. It could be the intercorrelations of the two or three components. And I totally agree with Dr. Hornstein's assessment on the North Carolina residual market, where they did the pre-event bonding and to make the residual market sustainable. I also want to point out that in North Carolina, another reason to stabilize the insurance industry is the availability of the consent rate, because as we know in North Carolina, the rate is a bureau, the North Carolina Rate Bureau set the rate for the entire state's property industry. However, the insurance companies, they have the option to deviate from the rate. So as we noticed, the insurance company from 2020 to 2025, the percentage of the consent rate has increased from 30% to almost 60%. So insurance companies are able to charge the rates they consider adequate. That is one of the major drivers to stabilize the insurance industry. And also my understanding of the residual market in the US, I still consider they are the policyholders' last resort. And all the statutes establish those residual markets, as well as the operation manuals of those residual markets, all reiterate that mandate. That is, they are the policyholders' last resort. So this is why generally every residual market provides limited coverage, that they have a limit on how much you can buy, and they also have the basic policy. Typically, it's not a whole-blown homeowner policies. So yeah, I consider residual market is an important component of the insurance ecosystem. However, I believe they should be customers' last resort.
Mhm. Thank you. Amy, just to shift gears a little bit, you're doing a lot of work in California and Colorado on the sort of wildfire stressed insurance markets right now. Um, could you share a perspective on what those states are doing to try to restore competition and create options for consumers? Because to Min Chong's point, nobody wants to be on the FAIR plan if they can help it. And so getting that ecosystem healthy is really an important part of the solution. Could you talk a little bit about what's going on in those two states?
Yes, thank you. And I really appreciate Samuel's research and sort of pulling all this together because a lot of the strategies that are being pursued in California and Colorado are taking pages from states that have had severe hurricane activity that has impaired competition in their states, like North Carolina, like Florida, like Alabama. And so some of the strategies that you heard Dawn talk about, grant programs for mitigation, that's a state support for for the grant programs for people who need some financial help to harden their homes against wildfires. That's a very critical piece that we've picked up both in California and Colorado from other states. The California, obviously, we've had a perfect storm in this state, right? We were feeling the effects of inflation on materials and material costs and labor since COVID, and it really hadn't come down that much. We had a series of brutal, large-scale wildfires starting in 2017, 2018, 2020, and then again this year, kind of at the worst possible time. So, and in Colorado, similarly, there were wildfires in 2014, 2010, 13, 14, and then this shocker of a wildfire that hit the day before New Year's Eve. It's like there was snow on the ground. What nobody's thinking there's going to be a wildfire at that time of year. So as Samuel was outlining, wildfires have become a more primary peril. They don't affect the same kind of broad swath of households that hurricanes do, but because they often cause total losses, they have a pretty high price tag, and now we see that. So as far as strategies, look, we have, as you acknowledged, United Policyholders starting in 2016, when the tree mortality crisis came to light, that there were over 120 million dead trees along the spine of the Sierra Nevada mountains. Insurance companies really noticed that. And, I was just at a conference in Connecticut on insuring our future, and the Connecticut Insurance Commissioner said, some people may think climate change is a hoax, but insurance companies definitely don't. So as early as 2016, we started seeing insurers withdrawing from areas in ways we had never seen. You heard Dawn talk about farmers threatening to leave, and we here in California we saw State Farm very, very publicly hit pause the Memorial Day weekend of 2023 and say, we're not going to be writing any new policies. Initially, they said, we're not going to be dropping existing, but then they started to do that as well. So we've seen the name brands severely reducing their footprint in California. We've seen it to a similar degree in Colorado, not as bad. Colorado just formed a FAIR plan, following up on what Min Chong said. Their FAIR plan came online. It only sells actual cash value, so it's a depreciated only. It doesn't replace what you had, and I think that the limit is like 750,000. So it's really not the kind of product that you want people to have on their homes. But it is a patch to a problem, right? These are take-all-comers entities. We had a question from somebody saying in the Q&A that she can't find coverage. Well, the FAIR plan is a take-all-comers, and so is the one in Colorado. Ideally, if you end up in one of those, you have there's a market. We have a market in California that's developed pretty quickly for supplemental products that are called difference in conditions, and they will fill in some of the gaps that a fair plan policy doesn't cover. So we've got the lessons, the strategies. That was your question. What are the strategies? We have, ever since we saw insurers starting to really dramatically reduce their underwriting here in California, we have dramatically increased our efforts to get homes hardened and both at the individual level and the community level. So both home hardening, so to the structure, and then the surroundings. So there's been a lot of fairly quick progress in the last 4 years. There's a key organization called the Insurance Institute for Home and Business Safety. They have a whole research facility in South Carolina. They're funded by the insurance industry. They've been doing research for many, many years on what can be done to make it less likely that a hurricane or that hail or that a wildfire will damage or destroy a structure. So we've got all this science now and this and standards that have been kind of fairly rapidly coming into place. We had good standards for how you protect a roof from being blown off in a hurricane. We didn't have standards for what you could do to reduce wildfire risk until just a couple years ago. So we've got all these efforts going on to finance risk reduction, to convince the naysayers that it actually makes a difference. And then the most important piece is to convince insurance companies that all this work is moving the needle and is making it less likely that they're going to get hit with these massive cats and these massive claims. So those are some of the strategies. I mean, here in California, and then of course, trying to strengthen the residual market is something that is happening. It happened in Colorado. It's happening here. Our FAIR plan, which is embattled here in California, and enrollment's been growing way too fast for anybody's liking, and they had to do an assessment after the LA fires, and we're learning as we go that our FAIR plan really needed to have a lot more pre-event kind of financing solutions in place that they didn't have, and now those are going to be coming online. I mean, there was a bill that got through this session that allows them to use something called the iBank to do the equivalent of issue the equivalent of a cat bond or borrow and have something that would not that would make it less likely that they will have to do these big assessments on their member insurers, which in turn then the insurers want to turn around and pass that along to their customers. So there's just a lot of work going on to deal with a situation that has come on fairly quickly, relatively speaking. And as somebody mentioned earlier, is impacting so many sectors. It's not just the individual households, it's realtors, it's lenders, it's municipalities, that rely on property tax revenues. There's just this is a very multi-level challenge that we're facing. And so taking pages from other states is really critical. And the last thing I want to say is here in California, our insurance commissioner put into place something called the Sustainable Insurance Strategy. And it's a multi-layered approach that recognizes that, as you heard Ming Chong talk about how North Carolina gives insurers a little bit of flexibility in terms of their rates. Here in California, we have had a very restrictive rate-making regime, which Samuel addresses in his work. And that has contributed to the pressure that insurers feel to underwrite fewer homes and to do less business here because they feel that their rates have been suppressed here and that they don't feel confident that they're being allowed to charge an adequate rate for the exposure they have. One example of that is the FAIR plan had asked for a 45% rate increase years ago. And it was in the pipeline. I think a couple years went by, they got 15. So I think, we've just got a lot of dynamics that are very challenging. Obviously, I'm a consumer advocate. I don't want to see people suffering. At the same time, the math has to work.
So I think that's a great place to shift back to Don and Minchung. And I want to ask you a question from one of the members of the audience, which I think gets at a really challenging issue for states in the Southeast, also California and Colorado right now. Jill Horing asks, how do you recommend balancing keeping prices close to actuarial pricing with equity and affordability issues, particularly for people already living in a high risk area as the risk continues to shift? And I think this is a really important point in California. Fire risk has changed dramatically in the last decade. Really, before the major loss events that kicked off this era really started to occur in 2015, I would argue. And there were a couple of fires then that were just kind of shocking in how many structures were lost. And then we went right into 2017, 18, 19, 20, and it's been a horror show. So we've got homeowners that are struggling to afford housing because California, and they have skyrocketing insurance prices. How should we be thinking about this balance? And I think Amy, is gesturing at this challenge in her response. But do you have a perspective on this issue? Do we just have to bite the bullet? Are there mechanisms that you think are effective for managing that transition to a higher risk environment?
Are you asking me or
I'm asking Don and Minchon.
Oh, okay, sorry.
Well, I'll take a first stab at it, at least tell you what we did in North Carolina. For starters, the North Carolina beach plan, the wind pool, does not set its own rate. Whatever the statewide rate is, that's it. Although there's a 5% surcharge that you add, perhaps, to reflect a slightly higher rate. But generally speaking, we don't do it by charging super high rates relative to the risk. Whatever the risk is, that's what it is. That said, we've been able to receive more than enough revenue every year when added to our ability to hit a $1 billion assessment on insurers who write in our state but choose not to write at the coast, which is most of our insurers choose not to write at the coast. We are by far the largest single insurance company at the coast. We insure something like 60, almost 70% of all homes on the Outer Banks and Barrier Islands. That's our riskiest area. And almost about 50% of the other coastal counties, like 350,000 properties. So we're the largest insurer, and we charge an amount that so far has been adequate. We can hit all the other insurers for an additional $1 billion, whether they write especially when those not writing at the coast. Honestly, it's just make them take the bitter with the sweet. They can do business in our state, but if they choose not to participate in the losses, we recoup that amount, at least up to $1 billion worth. And that helps keep rates down. And insurers so far have been happy to adopt financing mechanisms that allow them to do that. But lastly, it helps to explain why we have initiated our Resilient Roof program. We get no support from the state for this. We finance it purely out of our own resources and administer it purely in-house. And we have had little trouble actually bringing it up to scale. We've gone from just a 1 or 2 roofs about 7, 8 years ago to 20,000 roofs now. We have board meetings starting tomorrow, and I'm going to get money for the next year to spend another $20 to $40 million more on roofs that the board is happy to consider making, because the payback to us from these resilient roofs means we have fewer losses and we need to buy less reinsurance in light of the fewer losses. And it is cheaper for us to make the homes more resilient than it is to just continually keep jacking up prices. So it's proved to be the middle way for us that blends both safer properties, a more vibrant economy at the coast, and far more affordability than we otherwise would have seen. Mitigation is a golden path. It has its challenges, but my goodness, it pays back, dollars more than you invest in it. and insurance should be all over this.
Min-Chung, do you want to add any perspective about the sort of the national picture with respect to adequate rate and the challenge of kind of changing risk, rapidly changing risk, and getting to adequate rate?
Yeah,
Or
sure.
perceived adequate rate. I think Amy used that term, and I thought that was quite helpful.
Sure. Yeah, first of all, I also agree with both Amy and Don about the mitigation, because I used to sit on the Florida Modeling Commission, so I reviewed those mitigation credits. So I did notice when a fully mitigated home in hurricane, their loss propensity reduced significantly. Sometimes it's even like you can see 70–80% of loss reduction for a fully mitigated home. So I think in Commissioner Lara's sustainable insurance strategy, he also encouraged insurers to reflect that in the rate as an incentive to encourage the mitigation behavior. And we also see a similar loss reduction from the DINS data. So mitigation does matter, both community level and location level mitigations. Second, I want to talk about the concept diversification. There is a similarity between North Carolina and California in terms of the component of the insurance panel. So in California, top 20 companies make up for 90% of the admitted market share, and the top 10 companies make up 77% of the market share. Similarly, in North Carolina, it's also top 20 account for 90% of the market share, and the top 10 companies make up 76% of the market share. So very similar components. So those top carriers, they tend to be those national carriers. So they write everywhere in the country. So when you retain those companies, so that means when you add a risk to those companies, the marginal cost is relatively smaller because it's diversified with other risks they are writing in other parts of the country, including the Midwest, tornado, hail, and the Southeast hurricanes. So that we all understand that diversification will reduce the marginal cost of the policy. So it's far more expensive to put everything, all the risks in one pool in your FAIR plan, because FAIR plan also buy reinsurance, and even if they don't buy enough reinsurance, if they run a deficit, they are going to assess the policyholder. So in the long run, I believe that keep the healthiness of the market, provide the rate adequacy, and keep those large insurers stay put with the state is a long-term viable solution.
Thank you. So we've gotten a few questions about catastrophe models, and I want to raise that as sort of an interesting next topic of conversation. And I'll just sort of summarize a few and then allow each of you to respond and share some thoughts. One question was about allowing insurers to choose the cat model or in practice, I think many insurers rely on multiple cat models because there's lots of uncertainty in the wildfire space about the performance of individual models. So should insurers be able to choose, and if so, how much regulatory oversight should there be over the private cat models? And what is the significance? Recently there was a law passed in California that's going to require the creation of a public cat model. As I think, and I'll just say, full disclosure, I served on and I think Amy, you were there as well, on the advisory group that made recommendations to the legislature and to CDI about what that legislation should look like and what that effort should be. But how does at least the idea of developing a public cat model inform the use of private cat models? And then lastly, and I think this is really important, there was a question about what if everybody did the mitigation that everyone has been talking about? So if a community, say, were to fully harden the structures in the community so that they were maximally resistant to ignition during a wildfire, how would that actually filter through into the rates that community, the homeowners in that community pay, or the premiums that they pay, I betray my background in electricity when I say rates all the time. But the premiums that they pay and what is the process for translating risk reduction into premium reduction at the kind of local, more granular scale? Would anyone so CAT models generally, and then how changes on the ground in the field translate into premium reductions because of perceived reductions in risk? Anyone want to take a shot at that?
I am happy to start
Okay.
off. So, actually, when I mentioned earlier that taking pages from other states and the strategies that they have explored, actually, my organization looked at the fact that Florida has a public catastrophe model, and I communicated with the state regulator there and asked him, how is it useful to your agency? And he said it's been very useful. And we actually, suggested that that be part of the sustainable insurance strategy to consider developing one here. So, our working group looked at it, said, yeah, let's do it, even though it's ambitious, expensive, it's going to take some time. But the goal is to have a yardstick for the regulator. It's really, I don't expect insurers to use the public model. I expect them to continue to use the models they pay for, and that they give the specs for. Our California DOI, they do, they are adapting now. Insurers have gotten the right, as they have in every other state. We were the last holdout in California, not letting them use CAT models, and so RDOI is trying to, is going to have to really get up to speed. And they are adding staff to be able to competently continue to ensure that the rate filings are not going to lead to an excessive or inadequate rate by looking at these models. It's a challenge, I think. But I think the public model is quite a few years away. But I do think it will help us. It's been helpful in Florida. And on the second part of your question, part of the sustainable insurance strategy includes a regulation that insurers must consider, and they had to file, actually. They had to do a whole series of new rate filings to specify discounts, and so for specific mitigation actions. Insurers had wanted it to be all or nothing. They wanted it to be, you got to do everything on the Safer from Wildfires or IBH list and your community. So not just that, the individual home has to meet all those standards and the community has to meet a standard. The department took a much more consumer-friendly approach and said that you should adjust the rate for each of the actions. So they came back with here's a 2% discount, here's a 3%, which of course is not going to motivate anybody in any direction. But interestingly enough, I want to leave and pass it to somebody else with a little anecdote. Years ago, when we first started all this conversation about how, in order to get people to invest time and money in home hardening and the improvements they have to spend money on and taking out trees they love, we're going to have to incentivize them and we're going to have to reward them. And USAA had already been giving a 10% discount to people who were living in areas that had achieved a FireWise designation, which is good. But now we said, I think 15 is really the sweet spot of the number that will actually incentivize people. And sure enough, all these years later, the FAIR plan at this juncture has said they will give a discount of up to 15%. So for people who have met the Safer from Wildfire standards. So I think we're on the road. But I think, Dawn probably has a lot more experience with, with the numbers, with the discounts, because I look at North Carolina as a success story.
Well, I'll take that as a baton and just add a couple of things. First, on rates, at this point, I'll just say I'm indifferent to which models, I should say, that are used. There is no question but that in North Carolina, modeling has been not just accepted, but understood to be a crucial thing insurers need in order to navigate this brand new world, life on Mars that we live in which the climate has changed and risks going forward cannot really be projected just based on historical standards looking back 50 or 60 years. So modeling definitely can be used, and I'll defer as to any which models. I will say this, though, on to the second question about how you design a mitigation program and how it's linked to reductions in rates. And I'll make 2 points. One is certainly in North Carolina, that doesn't play a role at all for us. The actual amount of percentage reduction that we are allowed to give in rate, we have no rate making authority, is dictated to us by the Rate Bureau, which is this entity that is unique in North Carolina that's made up of insurers. And they give us almost nothing, 2 or 3%. They'll give a homeowner almost nothing for putting on a mitigated roof. It hasn't incentivized anything. In contrast to that, in Alabama, you can get serious double-digit rate reductions for putting on the same roof that we're talking about, these IBHS roofs that Amy referenced, which are tried and true, scientifically proven ways to reduce risk. And to some extent, those numbers are politically determined. I'm sure there's some facts in there, but there's an element of politics. I'll make this cautionary tale. You'll never get a more full-throated supporter of mitigation than you'll get from me. It's been a big success story in North Carolina. You have to be sure that the mitigation that we're looking at is cost benefit scientifically valid. And whatever the cost benefits are that the mitigation, in our case, these super roofs allow, has to be linked to the incentive that you give people. If you just start creating a political grab bag of amounts of deductions that you can make or reductions in the rate you can make, if you pick any one of maybe 10 different ways to mitigate your risk, some may or may not be legitimately tied to actual reductions in risk, you can give this very good idea a bad name. And I caution against that now. The way out of a lot of the mess, not all of it, but the way out of a lot of it in the short term is for insurers to get increasingly involved in mitigation. We're good at risk. We're good at administering big programs. We're good at dealing with numbers. We're very organized. We've proven that in North Carolina. But we are adamant, and we do serious cost-benefit analyses over and over again to link the amount of grants that we give, which is now $10,000 to the homes on the Outer Banks when they put on one of these super roofs. It is linked by study after study after study, real studies showing what the values to us are of these roofs. And that's what makes it possible for us to do it. So you have to be quite serious about mitigation and its true costs and benefits.
Minchong, do you have anything to add?
Sure. Yeah. I want to comment on the public model. In Florida, public model was developed by the similar group of excellent scientists. And the model I reviewed as a Florida Commission member. The Florida public model is not always higher, not always lower, and they are very similar to one of the commercial model. And also Florida did a really good thing to make the public model also go through the same rigorous commission review process. So that really gives the public model credibility. So the industry, when the OIR use the model to review, make decisions, industry respect that because it's a model goes through the rigorous standard. And so if California has the opportunity to also do the right thing to just make sure when you develop the model, it follows the same scientific discipline, and it also follows the same rigorous standards. Regarding the mitigation, I think I agree with Don and Amy. I just want to add, for insurance industry to give the mitigation credit, I think the best way to encourage them is to provide good data. So in the after January event, if we have a way to assess the impact of mitigations, that will give insurance companies the confidence and also give them statistical data points to develop the appropriate credit.
Thank you. So I want to ask, there are a couple of questions from the audience that I think are connected. One about why isn't there federal insurance for wildfire like there's federal flood insurance? And another that asks whether we could separate the wildfire peril from other types of fire coverage and exclude it from a standard HO3 policy and cover it separately. And I see these two questions as linked and perhaps also related to the way that we handle earthquake in California. And I'm curious, how folks feel about trying to separate the wildfire peril from normal homeowners coverage and HO3 policy and addressing it separately. Do you think that your experience from flood, experience from quake in California makes that look like a good idea or something we should be cautious about? And Don, I'll start with you because I want to ask you, this connects also to the recent experience in North Carolina around Hurricane Helene. And I'd love for you to just, if you have thoughts about this broad question.
Well, sure. So, Helene is an interesting, terrible story for us in North Carolina. For all the risks we historically get focused on, coastal risks, Helene is by far the worst storm ever to hit the state of North Carolina throughout its entire history, both in terms of its deadliness, but more importantly, in terms of the amount of dollars that it costs. It's estimated to cost $50 to $60 billion. Most of those losses were flood and landslides in the mountains. And if you look at most homeowners' policies, they exclude losses for flood and earth movements. The result was, and the number of people that actually had separate standalone flood policies from the National Flood Insurance Program was tiny, less than 1%. I think it was 0.8 of 1%. The bottom line is Helene, which is this $60 billion storm, was virtually uninsured. Insurers talk about something called the insurance gap worldwide. And countries that don't have established insurance markets, when they get a peril like this, I mean, it's a disaster. It's a political disaster because the private market isn't there. And because it's not there, the states have the governments, which usually have tremendous other problems they have to deal with, are left holding the bag themselves. So the bottom line from all this is you have to have markets that you have to have viable insurance markets. It has to be profitable for insurance companies to operate in a space to go a long way toward any jurisdiction's response from any disaster, including a fire disaster. So, on the one hand, I mean, that tells me that whatever you do, you don't want to lose control. You don't want to lose fire insurance, which is sort of a staple of a homeowner's policy, in light of something new. So I'd be careful. I'd think twice, I suppose, when you think about wildfires and whether or not you want to go the way of the California Earthquake Authority, which is a fantastic organization, by the way. But earthquakes are always viewed as sort of unique. And the extent to which wildfires are more like earthquakes than regular fires, I guess, is not an impossible thing to argue. But I'd be cautious about doing it. And I'll just close by saying it's not a bad thing to consider that possibility. But if so, then, I mean, it could be that wildfires is a really wicked problem. It's definitely a harder problem to deal with than we have in North Carolina with wind and roofs. I mean, for one thing, you can't put on the equivalent of a super fire roof on one home by itself without worrying what your neighbor has or hasn't done with wildfires. And even if whole neighborhoods get together and collectively rebuild in a nice, mitigated, slightly fireproof way, it really matters. What are you doing in the chaparral? What are you doing in the forest nearby that could affect whether the whole thing goes up anyway? It's a harder problem. And, if it's a harder problem, it might be the sort of thing that requires some sort of unique solution along the lines of earthquakes. And I guess that's exactly where the state is now. But the fact that you have fire coverage now isn't something I would just easily want to get rid of.
Thank you. We're at time, and I just want to thank Amy, Minchong, and Don for the excellent conversation today. I think we could keep going for a long time with this conversation. I really appreciate it. And of course, Sam Hudgens for the incredible work on the paper. Please do take a look at it and provide feedback to us. We're interested in hearing from stakeholders about what they think about Sam's work, and grateful to everyone for taking time out of their day to attend the webinar. Thank you and have a lovely afternoon.